Today's video is sponsored by Figure, the largest non-bank home equity loan lender in the US, with over $15 billion unlocked on their lending platform. They're now in the crypto-backed loan space and offering industry-low interest rates when you use your Bitcoin as collateral to get cash. Access interest rates starting at 9.9%, the lowest fixed rate in the industry at 50% LTVs. Whether you're funding a major purchase like a down payment on a home, investing in new opportunities, or even buying more Bitcoin, Figure makes it straightforward and transparent. Visit figure.com/Real Vision or click on my link below to take out a Bitcoin-backed loan with Figure today. Hi, I want to talk to you today about my friends at Bitwise and why they're the best crypto asset manager out there. I've talked on the show often about how crypto is reshaping everything from finance, portfolios, and even macro. Everything's ramping up. We've got tailwinds in DC, interest from TradFi, and growing optimism. But smart investors see all of this and focus on the how. What's the savviest way to seize this moment? And that's why so many investors I know are working with Bitwise today. They've been all in on crypto since 2017. They're OGs. They've got more than 30 products to help investors like you get access to whatever they need or want. They've got a team of more than 100 across the US and Europe, and they have over 10 billion in client assets. You know, a lot of people know Bitwise for their ETFs, how they manage the world's largest crypto index funds and the wide range of crypto ETFs they have. But not as many people realize, Bitwise manages private alpha strategies too, and has SMAs for large investors, and is one of the largest institutional Ethereum staking providers. They really do everything. These guys are true OGs in the space, and they're good friends of mine too. So please go and check out Bitwise. They're really excellent. Go to bitwiseinvestments.com and see all that they've got to offer. That's bitwiseinvestments.com, or just email them at james@bitwiseinvestments.com and let them know that Raoul sent you. Anyway, there's a million ways to access crypto. Explore how you can access it best with Bitwise. And remember, carefully consider the extreme risk associated with crypto before investing. Anyway, thanks so much. Hi, I'm Raoul Pal, and welcome to my show, The Journeyman, where I travel on that journey to the nexus of understanding between macro, crypto, and the exponential age of technology. These three things are the most important factors in our lives, not just our investing lives. But I know most of you are backing the fastest horse in the race. How do I put all of this together and make as much money to unfuck my future? The answer to that is obviously crypto. And so what I've done is something special. I brought Jamie Coutts, who's our chief crypto analyst at Real Vision, who also is part of Real Vision Pro, where myself and Julian Bittel and also Andreas Steno are all part of the team, producing really some of the best research in the world for you to navigate these times. Jamie is an extraordinarily good crypto analyst. He does things differently than me. I'm very top down, but he is bottoms up, detail driven, and he has some incredible insights that I wanted to share with you. I haven't caught up with Jamie for a while, so I thought we just catch up, have a chat, get his thoughts on what's happening in crypto, how to allocate our money, and where it's all going. I hope you enjoy it.
Join me, Raoul Pal, as I go on a journey of discovery through the macro, crypto, and exponential age landscapes. In The Journeyman, I talk to the smartest people in the world so we can all become smarter together.
Jamie, good to see you, my friend.
Hey, Raoul, nice to be back on.
I know, it's good because we've not caught up in ages, and we're both part of Real Vision Pro now because we've combined the macro and crypto. So I think it's just a good chance for us to catch up. And I want to see what your thinking is and, where it compares to mine, stuff like that. And I think people find it super interesting.
Yeah, look, I was at drinks here in Sydney. I think it was last week, and everyone was like, so how often do you speak to Raoul? I'm like, well, every time you see me on his show, generally, but so we'll do the catch up now.
Yeah, I don't know why we don't. We used to have the standing call, and then we've stopped doing it. I don't know what's happened. We need to get it back.
I'll reinitiate it. That's
yeah. So, okay, let's go through what you're thinking about markets now, because it feels to me that things are about to get really interesting. So I don't know how you want to go through the flow of this. I know you've got some decks and some other bits and pieces because you have a very unique way of looking at it. It's very detailed, and I think it's really helpful for people. Ever wish you could access cash without selling your Bitcoin? Ledn makes that possible. Ledn is the global leader in Bitcoin-backed lending. Since 2018, they've issued over $9 billion in loans, and not a single satoshi of client funds has ever been lost. Here's what makes a Ledn loan different. With a custodied loan, collateral is not lent out to generate interest. There are no credit checks. Funds in less than 12 hours, no monthly payments, and repay whenever you want with zero penalties. And they just don't talk security, they prove it. Ledn offers proof of reserve reports, verified by a top accounting firm every 6 months. Ledn is 100% focused on doing one thing better than anyone else, giving Bitcoin holders a secure and transparent way to unlock liquidity without selling. Learn more at www.ledn.io.
Well, it's been an evolution. So, I mean, I sort of start with the framework of thinking about everything. Asset prices are driven by liquidity, but there has to be very much a use case or a utility for a technology or experience sort of exponential adoption. And I think blockchain has that inherently. Bitcoin, store of value, and in a world which is becoming much more fractured and geopolitical risk and just the absolute palaver that is, sovereign debt in the US, but all Western governments right now. So it's now coming into its own. Its destiny seems to be pretty much sealed as the emergent, reserve asset of the world. Everything else outside of that has a lot more risk and a lot more beta because it's much more like early venture or early VC or VC style investments, but you get to sort of trade it on a 24-hour basis. But you can see the adoption rate taking place, and now you've got sort of top-down regulations and advances made by nation states to really embrace digital assets. So all that's great, but I look at the data more than anything because the headlines can really throw you off track, whether it's a positive one or a negative one. I look at adoption, look at the metrics that, once back tested and regressed against the prices, have some kind of signal. There's nothing perfect in crypto. There's nothing perfect in equities or fixed income, but there is definitely signal in the data. And I just try to build models which, sort of highlight statistical significance and provide us with some sort of framework for thinking about where things could potentially go and, when risk is particularly elevated. So last couple of months I've been working on really two things, but it's crypto wide, but it was, starting with Bitcoin specifically, looking at the sensitivity of Bitcoin to liquidity. So you have done all this work with Julian on liquidity analysis. I just thought I'd dig in a little bit deeper and start thinking about, okay, so traditionally Bitcoin does this when, liquidity increases or decreases. When has been the exceptional price rises or movements in the Bitcoin price, and what has that sensitivity to the global liquidity situation been? And I found that, it's very clear that we've had like these very bullish regimes where global liquidity expands very rapidly. And when it expands very rapidly, but also when it sort of breaks out of a period of contraction, generally Bitcoin sensitivity to the increase in global liquidity increases, it magnifies. And with a lag, so does crypto. So it's kind of something that we already knew. We looked back and we could look at the price charts and go, yeah, Bitcoin rallies first and altcoins rally next, and, so be it. But this is like just trying to really quantify it. So we've got, I think, a stronger guide in terms of what the potential price will be during this expansion period in global liquidity. And, on top of that, Raoul, for the pro community, I built something that's been irking me for like 2 years, which is, well, even longer. It's like some kind of risk model. So, okay, so you can sort of understand where the upside is if liquidity increases at a certain rate. But, there are other factors that plays a market. Like if you think about the last cycle, everyone's got PTSD as to, why Bitcoin didn't reach somewhere close to 100,000. That's what everyone was calling for, really without any sort of quantification of like why. But there's other factors at play. There's behavior, there's leverage. Typically, like these are the two big things. So if you've got ways of sort of tracking those things, and if you look at the past, then you've got a framework for understanding when Bitcoin is risky or potentially near a top. And that was sort of like the model framework, which, the pro community So I think in the last sort of like 2 or 3 weeks, we released that, and hopefully it's going to go up on the platform as a live ticking, risk framework that everyone can use on a day-to-day basis.
Hi, Raoul here. Listen, I think we've got until 2030 before the economic singularity arrives. Now, it might not be the exact date, but it's around then. So we have about 6 years to figure out how to unfuck our future. I've put together a report to help you called Prepare for 2030. It's going to help you take the first steps in that journey to make sure you're secure past 2030. So just click on the link below and start your journey now.
Fantastic. So there's a lot to dig into. And before we start, just observationally, I was out in the Middle East, last month, I think it was, and sitting down with like the sovereign wealth funds, and the mandate across the entire region, from Saudi to Abu Dhabi to Dubai to Bahrain to Qatar, is AI and blockchain. And not just using Bitcoin as a reserve asset, but also building the entire government infrastructure on blockchain, driving licenses, property deeds, the whole bloody lot. So it's it's fascinating to see. And then a lot of people say to me, well, if all of this money's coming in from the sovereigns, that may produce an outside return. And I'm thinking, well, if we're going from 3 trillion to 100 trillion, which is my estimate by just extrapolating out the trend rate of growth, you need larger players each time because the market cap is bigger, right? There's no way you're going to get to 15 trillion this cycle unless you've got bigger players. So it's kind of, I don't think it's what people think it is. I think it's just a function of the size of the market. The bigger it becomes, the more that those people are involved, and the more blockchain technology gets used, the more it uses the alts for infrastructure rails, for new forms of compute and storage and all the other things that are coming. So I just thought it was interesting because everyone's like, oh my God, it's a super cycle because of this. I'm starting to err towards, well, we've talked about this before, a longer cycle, just because the business cycle is still below 50. So generally it takes a while to climb up. And then we use the GMI Financial Conditions Index, and that has a 9-month lead. And with the dollar breaking down, even today, it's starting to suggest that this may go even into Q2 2026. So it's like the whole cycle got shifted because rates didn't get adjusted and the dollar was sideways for a period of time. So it feels that potentially there is a chance, and again, there's no guarantees in this world, that we're more like 2020 than we are in 2021. Or it's it's spookily similar to 2017 for me. So let's go through some of your charts, some of your framework, because I think people are going to love to see the work that you put in. I don't know where you want to start with that deck or whatever you think the best narrative are.
Well, I think we could sort of start with just the actual risk framework that I built, looking at global liquidity first. So it's interesting what you're saying about the sovereigns in the Middle East, because it's very much when you hear about the Middle East and crypto, it tends to be very, very Bitcoin orientated, right? So you've got United Arab Emirates and I think Bahrain are heavily investing into Bitcoin mining, and it just seems to be sort of very, very Bitcoin focused. But like, you're not hearing the stories like what you're relaying here coming out about the usage in government departments. So that's extremely interesting. It's been
mandated by the Sheikh. The ruling families have essentially said the future of the Middle East. I've always been bullish on the region because I think they're figuring out, what the world looks like without the oil and how do you invest the oil capital more efficiently. And they are just like, our future is AI because we've got endless energy right now. So we can do endless compute and data centers and all of that. That obviously plays for Bitcoin mining, but they have a lot of free cash flow and they want to become more modernized economy. So they're like, well, we'll build on blockchain rails and use AI in government. They're already using it in government, in asset allocation models, all sorts. So it's really interesting to see how fast they're moving. But yeah, you're right. Most people don't understand that they're going to be using a lot of underlying blockchain technology. That's not just the storing of Bitcoin for a sovereign wealth fund.
Yeah, it's just such a contrast to some of the Western countries that, are constraining themselves on the energy side, whereas, in the Middle East, they're overbuilding their energy grids. And because of that, they've got just all this extra use. I mean, they can basically monetize all that surplus energy with Bitcoin. But yeah, it's fascinating because, you can see where this is going to go in the next 10 to 15 years. The Middle Eastern countries are going to leapfrog a lot of other emerging markets, but, they could even well overtake some of the more established developed markets as well. Well, look, I mean, let's sort of bring it back to our friend Liquidity. So what I've got here is just my version of Global Liquidity Index, which is, aggregation of private credit through, global M2s, or the global money supplies of large countries, central bank balance sheets, FX reserves, US net liquidity. And
this is similar to our GMI total global liquidity. Yeah.
Yes, okay, it is. Yeah. Yeah. So what's your number roughly? Do you remember?
I don't know actually.
Yeah. Well, it's you can see that there's a very tight correlation. Like depending on the data set you use, the regressions, the R squared, or the the explanatory factor of global liquidity on the Bitcoin price movement is very, very high. It's like one of the strongest relationships in financial markets.
Yeah, we get, using ours, we get 90%, 88%.
Yeah, and I'm in that ballpark as well. But what's interesting is that that's a relationship, that's a sort of linear relationship over the time period, but there are periods where Bitcoin becomes hypersensitive to the changes in liquidity. We've had these periods where, global liquidity goes sideways, and actually Bitcoin usually tops before global liquidity tops out. So it's
like when the rate of change of global liquidity slows down, it starts topping.
Yeah, because this has been driven by, in the past, a lot of central bank activity as well. So central banks move very, very slowly, but the market detects when when break-even starts to break high, the market starts pricing in higher inflation, that the central banks will have to pivot. But they don't pivot on a dime unless it's an emergency when they're adding liquidity, but never when they're withdrawing. So usually Bitcoin will sniff it out many months in advance, and we'll see the top form, and then global liquidity will roll over. But the contraction periods in global liquidity traditionally have only been sort of 24 months, so 2 years. And that was in 2014 and 15, then in 2018 and 19. The one that we've just gone through has actually been 3 years. So to your point earlier about the cycle being elongated, if you look at global liquidity here in white, it's been it was down sharply in 2022. And then we just had this sort of contraction period, like a wedge pattern that we've sort of been squeezing into and now breaking out of. So a longer contraction.
Buying that low in the first, that's what we did. And it worked really well. Back end of 2022, when global liquidity, it doesn't give the strongest price action, but I don't know, Bitcoin's up 6x since then. So it does work just by getting the bottom of it. But the breakout is when it really counts, right?
Yeah. So the tops are harder, but the bottoms are easier actually, because, at the bottom, it's usually sharp central bank actions. And that's the signal. You sort of don't have to sort of second guess that. And now that we're starting to break out, and you look at this sort of breakout of the last contraction period, and obviously 2020 was exceptional, so we're not looking to repeat that. But generally, if you look at the previous times we've gone out of a contraction period, that has been what I define as like the super bullish liquidity regime. So, global liquidity can only contract or go sideways for a certain amount of time because the whole system is so indebted that their default risk rises, and also just the interest cost on debt becomes too excessive. So there's always an impulse to add liquidity. And so like a beach ball under the water, if you keep it down for too long, it's going to burst out, and we're starting to break out now. And so in the past, when we've seen a breakout of the previous all-time high in global liquidity, Bitcoin's sensitivity to the changes in liquidity triple at least, sometimes 4 or 5x. So
right
in my analysis, global liquidity goes up by 1%, Bitcoin usually rises about 7%. But in these particular regimes, that goes to 20 to 30 times. So a multiplier of 5. And what's really interesting is that we got the breakout in global liquidity in early April as the markets were sort of tanking. So that was this low that we went through, which really wasn't much to worry about, like in terms of Bitcoin pullbacks, but it felt pretty nasty at the time. Massively outperformed the S&P, massively outperformed the equities on a volatility adjusted basis, even though, it was down 30% and the S&P was down 20%. On a risk adjusted basis, massively outperformed equities. And so when it broke out, when global liquidity broke out in early April, Bitcoin rallied 40%. Global liquidity from that breakout is up about 2%. That's roughly what it has done in those previous bullish regimes where global liquidity breaks out to new all-time highs. You get a sensitivity factor that is factors higher than it typically is. And so for me, it's interesting that, we're not overbought, based on liquidity. Every new dollar that's created, whether it's even through like the US dollar weakening or depreciating is an easing on financial conditions, it all adds liquidity into the system or makes financial conditions better, and the relationship is strong. And so, I'm looking at now a market that is not overheated at all. In fact, it's doing what it should be doing, and it's not doing anything excessive. So I talked about a framework for sort of modeling the risk. What I did was I converted that relationship into a risk score. And the risk score for global liquidity is just this one here. It correlates pretty well to the tops in Bitcoin. So what you want to see, it's a rating system of 1 to 5, but I've also got percentiles, and we'll be publishing them onto the RV platform. So if people want to get a little bit more granular, like if we're at a 4, does that mean we're at 82nd percentile or the 88th percentile, the 90th percentile? We'll get that granularity shown as well. But what it's designed to do is to say, okay, anything below a 4 is sort of just neutral, normal conditions. When we're at 4s, you have to start thinking about, okay, if there is chips to be taken off the table in Bitcoin or crypto.
And this is not necessarily the full cycle top. It can be sub-cycles within, right? Because I'm looking at got to 5s a couple of times, backs off again. So you kind of use it like a weekly RSI kind of idea, is like an overbought, oversold indicator.
Yeah. So what you said is like perfectly correct. It's like you've got to use it with some context. Like an overbought RSI at the beginning of a breakout of a long-term downtrend is not a sell signal, it's a buy signal. But this is a little bit more calibrated to knowing when things are really stretched relative to the one the one statistical relationship which really seems to matter, which is liquidity. So if it becomes extremely stretched versus liquidity, even in a mid-cycle scenario like we saw in early 2024, so we got that read when Bitcoin was around 51, 52,000, it topped, within a week or two at sort of 73,000. So it doesn't catch the top. None of these are going to catch the top, but it tells you when global liquidity, when the price is stretched versus global liquidity. And of course that's
how I think about this to explain to people is call it a 90% correlation roughly. It's when you look at what's the other 10%, it's often the fear and greed, the elements where the market gets over ahead of itself, which is what you're picking up here is like the deviation from the trend versus liquidity, right?
Yeah.
So when it gets too obscene, people have taken too much risk. And then you've got other scores like leverage that then you would add on to that and say, yeah, and the leverage is built up and that's why we're in excess.
Yeah, exactly. So like I probably should have said this from the outset. It's global liquidity, it's leverage and positioning, and it's unrealized profit. So when you get the confluence of those things,
it's broader than just deviation from liquidity.
Yeah. And that's important because that tells the other side of the story. So, okay, you can say that, okay, it's stretched in terms of where it is relative to global liquidity, but is there excessive leverage in the market? Like if that is also happening at that time, boy, oh boy, do you have a very strong signal for a looming market top, because derivative like open interest and the factors that go into the leverage component of the derivatives risk score are very finely tuned to tops and also bottoms. So that plus also unrealized profit, which you can see on chain, come together in a very good way, like in terms of the confluence that you can get from it to give you sort of high probability zones of when things will top and bottom as well. So this was indicating, that in the early part of 2024, just a couple of weeks before we had that top, which I'll show you with the next chart on the derivatives one, was really driven by the derivatives market. Just was so excessive in Q1 with the launch of the ETFs that it was destined to correct. It only corrected by 25-30%, a pretty normal correction, but it did take about 6 to 7 months to unwind all that positioning. And then we also got an overvaluation read on the global liquidity risk score in December as well. And if you remember back then, you were talking about it, I was talking about it, like the dollar was strengthening, like liquidity was tightening as we rallied very, very sharply into Christmas. And of course, then we had the fallout for the next sort of 3 to 4 months. So now where are we? We're at a score of 3. We are neutral. There is sort of that 40% rally off the lows of April is just the normal, the normal relationship playing out.
Okay. Super interesting.
The next score, the one we refer to, is called the derivatives risk score, uses several inputs, mainly on perpetuals, futures. I'll be pulling in sort of options and other metrics when I can, but here you can see that the timing of this signal, you have to kind of ignore the 2020, 2021 market. That was extraordinary. Funding rates remained elevated for 12 months. And that simply was just a function of an immature market, and also the type of investors that were trading it back then. There's just no way funding rates can, remain at sort of double digits, weeks and weeks and months on end. But if you look sort of more closely to what happened in 2022, it picked the bottom very, very well. And in early 2024, again, when the ETFs were launched, the actual top, the risk score of 5 came very close to the market top. And then again in December of 2024 as well. So this tells that other side of the story. So if you're overvalued versus global liquidity, is it driven by spot or is it driven by leverage and derivatives? If it's driven by the latter, that is a much more serious problem because that unwinds more quickly.
So, I mean, again, brilliant work. So looking at the liquidity risk score, we're neutral. Looking at leverage, we're kind of low, not even neutral, we're pretty low, which is suggestive as we go through more of your work that, we've got a potentially larger move at play here because we've got very little headwinds.
Yeah. So it's exactly very little headwind. If the positioning was so one-sided at this point, especially around an all-time high, like we got in this one here back in Q1, this was pretty much level with the old 2021 high. So you had old resistance, but you also had far too much leverage and positioning all one way right at the top. So it was just it was a recipe for a pullback. We don't have that now. So it's just, it's very, very muted, which is great to see. If we rally to 140, 150 fast and that all builds up, that changes the situation, altogether. But if we get a nice market move where leverage doesn't get ahead of itself and that positioning isn't sort of all one way, then this actually provides the support for higher prices and a longer cycle.
And do you look at leverage in terms of percentage of the overall market cap? Because the natural leverage number will expand over time as more people come into the market using derivatives. But we've got these larger players as well. So as the market cap goes up, we have to measure it as that kind of percentage, like we do with short interest in stocks and stuff.
Yeah, not exactly. But it's very coincidental. Like, so if Bitcoin goes up, open interest goes up. So there isn't much signal there. So for me, the signal is the rate of change.
Right. Okay. Makes sense.
Too much, too fast.
Yeah.
And then there's funding rates and there's options and there's, options skew and there's, other things we can use as well. But generally that's kind of the way I look at it.
Okay, so what next?
And the third one is network profitability risk score. So this is the on-chain metric. So this, there is like a multitude of metrics to choose from now. There's some great providers out there. I use Crypto Quant, Glassnode's obviously another one. There are others. And there's lots of different ratios and metrics that have been devised over the years that have been pretty good indicators of market tops. So this is really a synthesis of quite a few of them brought together. And this is the other part of the equation. So you've got global liquidity, which, just from a first principles basis, we understand drives asset prices. So you want to study that relationship. Number two, regardless, leverage can ruin a trend and they can provide opportunity. So you've got to understand how the market is positioned on that front. But then you've also got to understand the on-chain spot holder basis. And so metrics like MVRV, NUPL, so MVRV is market value to the realized value, which is essentially, it's thought of as the, measuring the cost basis of the entire network. What is everyone's holding cost? And therefore, what is the unrealized profit between the market price and that cost basis? Another metric, NUPL, unrealized profit loss, does sort of the same thing, but it's sort of, it's bounded to 0 to 100%. And there's another metric, which I find quite useful, called SOPR, or Spam Output Profit Ratio. This tells you when a certain segment of the holder base, namely long-term holders, which are statistically significant, when they are doing things, or when they're, either buying or selling in mass, then that has correlated very much to market tops and bottoms. So, all of these things together right now at a score of 3 is saying it's pretty, it's normal. It's not excessive. So the unrealized profit of the network isn't too high. The long-term holders aren't dumping coins, which they typically will at a market top. And so, that is not happening excessively right now. Again, if we go to 150, 160 quickly, then that could very much, spike up and we start getting a score above 4.
Super interesting.
Put all those together. So I haven't sort of distilled it down to one score, but I'll be doing that. And
that's where it's going. Obviously, one kind of mega
people,
dashboard.
Don't give me the 3 scores and the percentiles. Just give me the one thing. So we'll do that.
Yeah, great work. Now, the other dashboard that you use is the one that's on the Real Vision platform, just running through, some of the key tokens and stuff like that. And also, if there's anything else you want to add about Bitcoin, I mean, what you've shown us is it's super neutral from here, so we can have a run and let's see what leverage and other things build up. What else should we be looking at?
So looking outside of Bitcoin, so we are in a super bullish liquidity regime, right? So, and Bitcoin is going to be breaking the all-time high. It already has in the last week or so, and it's retraced. And it could chop around here, but I don't think we're going to see a hell of a lot of downside, not a large move, given those 3 risk scores where they are, then none of them being excessive. And so, through the analysis that we've done, there's obviously this sort of lag that occurs with the rest of the crypto complex. And, unlike previous cycles, the adoption's coming through, and now we've got sovereigns and nation states endorsing, attracting businesses that are focusing on blockchain. So there's a whole new element or dimension to it, but it's still a very hard asset class to trade because most people by now would have thought that it would all be en masse a lot higher, but it's been very selective so far. So the way I've tried to think about adding a new lens on crypto market and the broader sort of altcoin market is just sort of adopt some of the traditional market breadth analysis that you and I have been using for 20, 30 years and bring it to the crypto market. And the only way you can do that is if you start using sort of index data on crypto. So I've partnered with this company called Bitformance, and we've created the top 200 index, market cap weighted, equal cap weighted. Then we've done sectors and subsectors. And so that allows me to do all sorts of interesting things from a market breadth perspective. But this is just a chart showing the top 200 equal weighted index. So it's a pretty good proxy for altcoins. Every single asset in the top 200 weighted equally. And you can see it's been stop, start, stop, start. It's, the opposite of the Bitcoin chart, which has pretty much been up to the right. We've had these bursts of activity. So what I've created is an advanced decline line. So equity traders and investors are familiar with this one. So equity, the advanced decline line should be going up as the market goes up. And if it starts to trend down as the market's going up, that just means that less and less assets are participating. In crypto, we've had a structural bear market ever since the 2021 bull market, where you can see here that prices have sort of tracked sideways, up to sideways, but the ADL, which is this white line in the subchart, has been going down.
And this can also be, I'm guessing this is highly correlated with Bitcoin dominance.
Yes.
Is another simpler way of looking at it.
It's because of the market cap aspect of Bitcoin dominance, it doesn't tell you as much about breadth as like the ADL does. Yeah. It's just another, I use the Bitcoin dominance chart as well. But what I'm starting to see is, I was calling this back in March and April that the bottom was forming in altcoins. And so it doesn't look like much now, but we are starting to move higher with higher lows. The oscillator, which I've created like a MACD, really does do a great job of coinciding with a typical Altseasons or bursts of outperformance. And so that triggered in April, late April. Now, it feels like a shitty Altseason because if you look at sort of the DeFi coins, some of them are all round tripped in the last, couple of weeks. But it's structurally looking like we are building an Altseason right now. And this is just one of the clues that I look at to show me that, okay, we've got higher lows on the ADL. The MACD is positive, and even though we've pulled back over the last couple of weeks, it's still positive. And so instead of these short bursts like we saw in Q4 of 2024 and sort of Q1.
Does this chart go back to 2021 so you can see what a full alt season looks like?
Yeah. So
yes, so you can much fatter. Look at that. 2020.
Right. So 2020 and 2021 was extraordinary because we actually had a rising advanced decline line. So that just meant that the number of assets in the top 200 that were making new highs every day was positive, cumulative basis, day on, day out. And then really in this bull market, it's been sort of a structural in this sort of
does this go back to 2017, which is, I think, the most similar to now? I don't know if your data goes back that far.
It starts to get a bit wonky because the index construction going back before to 2020 was pretty hard. So I don't even trust it. And you can see on the chart here, it just there's a rebalance here, so I don't tend to use it. I wish I could. It maybe if we sort of created a top 50, it would be a better data set to work with in that 2017.
Yeah, because there was just less around, right? You had a bunch of ICOs, but you didn't have a lot of alts, really. Not like now.
Yeah, you couldn't have even really put together a top 200 back then.
Yeah, agree.
So
this is the start of an alt season you're seeing there.
Yes, yeah, it is the early signs. And the Altseason indicator, which is the number of assets in the top 200 that are outperforming Bitcoin, bottomed again in sort of March, and it's been sort of a tepid rise. So it's now at about sort of 17%, which is to say only 17% of the top 200 have outperformed Bitcoin in the last sort of 90 days. You can see that, a good Altseason will see a broad multi-month rise in the Altseason indicator, whereas we've seen sort of very narrow, sharp rallies, but not to the sort of levels that we saw back in 2021. And look, I actually don't think we're going to see, broad-based outperformance of Bitcoin across the entire market. I mean, you'll see periods over the next year and a year and a half, maybe where you've got like, 80% of the assets in the index outperforming. But honestly, I think the market is starting to act with a bit more discernment. I say that in light of the fact that like some of the meme coins have been doing really, really well right now. So it's not like fundamentals are everything. Culture still matters. But as this market becomes much more sophisticated with the type of asset owners and investors that are coming in, they're going to start using fundamentals. And if there is no net worth growth, either in a protocol or in a layer one or a layer two, it's not going to rally just because Bitcoin's rallying. So
Because also, I think of it as a function of the amount of capital and attention available, right? So, like attention times capital, right? That's the whole game in this. And there are so many coins now, ignoring all the meme coins for now, but just generally speaking, there's a lot. So, we don't have enough capital to drive all of the speculation and all of the things. So, the market has to focus where the attention goes. And so, yes, you'll see pockets of memes doing extremely well because they capture attention and thus capital. But generally, it feels like the mid-tier outperforms Bitcoin, but the bottom tier, there'll be cases of things that do because they're new and they're interesting and they get attention. But generally speaking, there's just not enough capital that flows that far out the risk curve.
yeah, I'd have to agree. There's definitely going to be some there's going to be some big outperformers for the rest of this cycle. So you'd want to at least be keeping a fairly close eye just on network growth and adoption. But yeah, I mean, I think it's like the meme. Is it one of the meme coins? Is it SBX 6000 or something? You probably know this better than I. It's been
it's SPX 6900. I get trolled all day because I once mentioned it and I don't own it. But yeah.
Yeah. So there's going to be stuff like that for sure. But I think there's ways in which investors can have exposure to the altcoins and do it through sort of a much more rational, fundamental lens. And we just had actually the head of data at Blockworks Research on RB like yesterday. I interviewed him, Dan Smith. He's been doing quite a lot of work in sort of understanding new demand metrics. And so he, instead of looking at just fees, Blockworks is sort of promoting the use of something called real economic value, which includes fees, but also MEV. And I went and back tested the data, and it's actually got a pretty high correlation to price as well. So, this is all going to get understood very, very quickly by, the Franklin Templetons and the Fidelities and all the new asset managers that aren't in the space or that will be coming into the space, because they're sure as shit not going to start, following.
They need to sign up for Real Vision. They need to sign up for Real Vision Pro. That's where you get all of this and all of the macro work that we do as well. That's what they need to do.
Yeah. Yeah, absolutely. Good promo.
Yeah, but it's, I don't think people understand the depth and breadth of what we do at Global Macro Investor. The sheer amount of stuff we do on the macro crypto nexus, and then what you do in a lot of statistical analysis, a lot of in-depth analysis, real depth in stuff. This stuff doesn't exist anywhere. I mean, I'm really proud of what we've all built. It's just very cool.
Yeah, look, I mean, the degrees of freedom that we have at Real Vision to go explore like corners of the market and also bring the institutional lens to what's been a pretty cowboyish space really for the last couple of years is truly exciting. Like no constraints, and just also, I guess bringing that more TradFi sort of lens into the space. I think it definitely helps.
Yeah, I think so. And, just again, I'm going to do a small plug because I think it's important is like, if you are a hedge fund or an asset manager in the space, you can also contact us about, getting specifically Jamie's research or the macro research, and we can figure out ways of doing it. It's important for us. Jamie and I are driven by the same thing, is like to give as much information to as many people as possible and to help people in their journey. So it's a key thing. So what else are you looking at here in terms of, I see you got some other tabs open for Altseason.
Yeah, just, I mean, look, what I might actually do, Raoul, is, because I know we're limited in time, is just sort of bring up the dashboard for...
Yeah, that's great.
The blockchain economy.
It's a great dashboard, always.
We talk about fundamentals, so, let's think about this.
This dashboard's now real time on the Real Vision platform, right?
Not yet.
But it's coming.
Yeah. It's coming. We're gonna get this one up and a couple of others which actually break down this information by the assets, so you can do sort of cross asset analysis. Look, there are data vendors out there that provide, on-chain data. I think where the magic is actually transforming that data, cleaning it up, and showing the stuff that has the signal, because there's no shortage of metrics to get sort of tripped up in. And if unless you're building models yourself, dashboards need to deliver the things that have the highest amount of signal. So, you can see here that I've got sort of R squareds built in, so you can see, okay, what tends to matter. But also, like, if we're analysts in the space or we're looking at it, we obviously are investing in assets, but we want to know what the ecosystem, what the economy looks like. And so what I've done is I've aggregated it across all the assets, L1 assets and L2 assets, to give a sense of like the blockchain or crypto economy. And so here we can sort of see these aggregated numbers. And, in the last 1 month, if we just look at this column here, we've seen a surge in DEX volumes, and that's really been driven by Hyperliquid, which is, an exciting project and has been doing extremely well, outperforming everything.
Feels like it's going to be one of the I always think there's usually 4 or 5 things that run the full cycle. It feels like Hyperliquid might be one of them.
Yeah, I'm there too as well. I've got a report.
I don't own any, but I just, it's phenomenal price action.
Well, this is what kills me, Raoul. So I'm going to put this in my report because I have to own it. It's my chart of shame, which is my trend indicator triggered on Hyperliquid in early May at about $17, and I didn't pull the trigger on it. I was busy writing a report actually, and I was like, I'm writing this fucking report. I'm going to get it done. The price isn't going to move. I'll be right. And sure enough, it just rips in my face. It's 40, like that was 17. Now it's 42. I look at the fundamentals of it, and I'm thinking, no, this thing's going to go. This thing's going to rip and continue to go. It's got a market cap of like 12 billion, fully diluted market cap of about 33. So it's big by crypto standards, but it's doing like $1 million a day in fees. Like, it's trades on a market cap to fee multiple of around 40 times, which, a high growth tech stock trades on multiples higher than that. What's Tesla's sort of market cap to sales? Or, it's, most other blockchains are trading on thousands of market cap to fee ratios. So, it's got unlocks and everything else. It didn't mean to turn this into a Hyperliquid plug, but it's more of a case of just like airing my regret for missing that trade. But yeah, look, DEX volumes are up 95%. Daily active address, all these metrics took a huge hit in Q1 and they're bouncing back. So from just sort of like the network adoption or activity standpoint, these metrics matter. That drives price. There've been a pretty big sort of turnaround in the last month. And, you can see that, we're starting to track back up to sort of the 98th, 99th percentile of the history. And most of these assets are well below their lows. So you can sort of think of that in two ways. You can think that maybe the market's becoming a lot more rational and is, ascribing a less of a premium. That's, I think, is definitely true because, we can't go back to the 2021 multiples, which were just completely unjustified. But at the same time, at some point, these assets are going to start to really move because there is a lot of activity.
I think they always decouple at the end of the cycle. There's so much fear and greed that comes into crypto that it always decouples. Because look, the reality is everybody's hopes and dreams are in this trade. This is the only way to unfuck people's future. And so it sucks people in too late. Obviously it always does. And it's a problem, but it's a feature, and the indicators you built before actually really help understand where are you in the FOMO cycle. Because it's basically those indicators put together are basically FOMO.
Yeah, pretty much. Maybe we should just relabel it that. So you're thinking Q2.
When you put the single one, it should just be, the RV FOMO index because and
if it's like 4.5, get the fuck out.
Yeah, that's right. Or realize that you should get rid of your spot positions and own a call option instead, or whatever it is.
Yeah. So you're looking at Q2 now. It's kind of like where you've arrived at, where you think
not 100%, but we're kind of erring that way. I mean, definitely Q1, but it's looking like it might run all the way through till, end of H2, which kind of makes sense. Again, the ISM, the business cycle, is the driver of speculation, risk, excess capital, all of that stuff, because people have higher earnings. We're not positive yet. So although tech stocks have done well, stock markets have done decently well, Main Street has not. Businesses are still struggling.
Yeah.
But once that turns, and I think the Federal Reserve will be cutting rates because, as we've been saying for a long time, Julian and I, inflation is coming lower, and it is. Then we will see Main Street or people with mortgages, household income increasing, and that pushes people out the risk curve, and that's what drives the real cycle, particularly the Altseason. So the Altseason we find is highly correlated with ISM, and it makes sense. It's just, have you got more money to throw into the market?
The chart on Bitcoin or Ethereum Bitcoin too is very interesting, right? So you can see it's impulse higher, sideways range right now. It just looks like that is a flag ready to break out again.
Yeah, and I've got the same. It's the same as the Bitcoin dominance chart. To me, it's either forming a large head and shoulders top or a GMI crash pattern, which is the fall, the rally, the failed new high, and then again a big move lower. And it would make sense. But we need the ISM. We need disposable income or disposable earnings to rise so people can recycle capital into more speculative things. Because right now they're still struggling to pay for a steak dinner because it's $150 fucking for a steak in the US. It's a big issue.
There's tax cuts, in the second half of the year.
That's going to help too.
Yeah. Well, it's pretty scary. We're paying about $120 for a steak down here as well.
Yeah, it's amazing. I'm in Spain right now, and you're not. It's a lot cheaper, but there again, earnings are a lot less as well. So let's go. You've got a version now of network activity across different chains, right? I think that's useful. What's looking interesting to you? Well, let's look at ETH, for example, because ETH is starting to move. What are we seeing in ETH via your lens?
Yeah, so, I mean, fees are up 100% in the last month. Okay, so fees are a bit tricky because they're denominated in the the underlying token price. The token moves, that also moves the fees as well, but it's correlating as well to a 30% increase in DEX volumes. The fees in ETH are up 60%, so that's pretty substantial for ETH. And
sorry, are the fees in ETH going up because of the restructuring of ETH to accrue more to the base chain? Is that what's going on here?
No, I think it's just it's a combination. Definitely activity on the chain has increased. So that's what you see, from the daily fees in sort of native ETH, right? So that's non sort of US dollar denominated fee growth, but it's also partially due to price as well. So there's sort of dance that activity and price do together. Sometimes they're very, very sort of intertwined. You don't know which one leads what, but generally I would say that, you can see that overall activity on the chain has definitely increased, and that is a major driver of the increase.
It's also interesting because, I still like the daily active addresses way of looking at things as well. And you can see how little it grew in 2 years, 4 years. It's only grown by 2%. So, ETH has been relatively dead compared to, if you were to compare daily active addresses growth across different chains, you'd see very different numbers, right? And that's one of the things that happened to ETH.
Yes, yeah. We've got a dashboard for that as well.
Do you include the layer 2s in this, or is it just layer 1s?
No, no, so the answer is no. I did Bloomberg Intelligence. I've just got to recreate that as well, and then think about how to adjust it for what that means for the ecosystem.
I tend to think, I try not to overcomplicate it. So you could look at the ETH economy overall, the Ethereum or EVM economy, let's call it that, and then look at the total wallet growth, the total value transacted, those kind of things might give a broader perspective than just what accrues to the base chain. I don't know. We all kick around this idea for a while and nobody's quite sure how to do it yet.
Well, this is something that we were talking about offline. So, but I'll mention it here. I went out and looked for transfer values, which I know you got your hands on a couple of years ago, and I used a data provider at one point that definitely had Bitcoin, still has Bitcoin and has ETH, but doesn't have every other L1. And it's just bizarre that we don't have that metric from the on-chain data companies, because that was your initial
Masari used to have it. Masari used to have it, total value transacted.
Yeah, they don't anymore. Trust me. I don't know why, but yeah, it's just a basic metric. But yeah, it's also the other thing is positioning. No one owned ETH. It was probably the short side of a lot of pairs. And if you look at the ETF flows now, they're starting to really pick up. So, combination of increased activity, timing in the cycle, and just so much negative positioning or underweights.
Let's have a look at any of the others, because observationally you've looked at this stuff. What are you finding amongst the chains that is interesting?
Okay, so what I find interesting is a couple. And this is, I put this into the last couple of notes. If you look at, let's just take what Blockworks are talking about in terms of REV. When you look at, the total value that a user is prepared to pay to be active on a chain, which includes the base fees, all the tips, and the MEV. Solana looks extremely strong and growing relative to ETH, undervalued. It's really compelling. Then you've got, chains like, in the last couple of months, the activity on BNB, which I kind of ignored for a while, has really started to pick up as well. And also Tron. Tron, I've written about Tron and how I used to shit on it all day long. You can't walk away from the fact that it's doing around $9 million in fees. And again, speaking to Dan Smith from Blockworks yesterday, I asked him the question. It was like, how much of that do you think is wash trading or is fraudulent activity? And he's like, he's tried to unpick it every single which way to try and answer that very question. And he's sort of come to the conclusion that no, I mean, there could be some, but at that level, this is like legitimate transfer value. There's very little activity. There's, the DeFi activity on Tron is, very, very small, which is
it's all stable coins then.
Yeah. It's all Tether and Tron's native stable coin. So, if you look at it from an ecosystem standpoint, what you want is, Metcalfe's law and Reed's law, right? Well, basically, number of interconnections and then sub communities creating, like Bitcoin has with Lightning and mining and, all these other. Yeah. Tron is very uniform. It's a stablecoin platform. So it doesn't have some of those aspects you look for it from a network effect, but it does the one thing and it does the one thing very, very well. And so, it makes, more from fees alone than any other chain. So, if you look at the chart on Tron, it's exceptional. It is, it's up and to the right with very, very low volatility. So it doesn't move as much when the market goes up, doesn't go down as much when the market goes down. And, it's got a massive burn. So Tron looks, pretty interesting for the rest of the cycle. It's probably
how about Ton? I had Manny Stoltz, who's the head of the Ton Foundation. Now, Ton's got this weird thing that it's got a massive network, but it's got to get that network to use its native token. Are you seeing anything in Ton at all?
Not in the last couple of months, to be honest. There was pretty good on-chain activity in the middle of last year during the sort of pullback bear market that we had. And I thought that was interesting, but that kind of leveled off. So there's a lot of incentive-driven activity, which hasn't really followed through. I think it's got a ton of potential. I mean, it's got a captive almost 1 billion user base. But again, the activity, the adoption metrics I'm looking at, it hasn't come up in the top quintile of assets in the screens that I've been running.
And what about Sui after the Cetus hack. What happened with that? Because there was the DeFi protocol that was built on top. That's a separate business that got hacked. It all got made good in the end, but activity went. Has it come back? Are we still seeing strength in the Sui ecosystem?
It's leveled off. It pulled back, and then it sort of regained about 50% of the pullback pretty quickly. But it hasn't got back to the highs that it was doing in, when was the hack? It was probably sort of mid-May.
Yeah.
Yeah. So I would say that the performance since the hack has been robust, but because of that knock to the relative performance, as it's the momentum, it's the rate of change, and Sui's rate of change of network activity was really moving Q1. And it was the reason why, I wrote about it in one of my reports in April where we doubled down on it, because during the bear market, as things were capitulating, TVL, stable coins, DEX volumes were all going up. And there was there was two chains that were doing that at the time. And the other one was Sonic, which was heavily incentive driven. So the fact that all this activity was happening right into the lows of the capitulation of that bear market was a massively bullish sign. So it massively outperformed.
Exploded out of that bottom.
What's that? Sorry?
Yeah, it exploded out of that low. I mean, it was shocking. It moved so fast.
Yeah. And so then we had the hack and it slowed it down. But it still looks fine for the rest of the cycle.
And finally, how does Hyperliquid stack up on the way you look at? I don't know if you're looking at that yet, but
it's killing it. So, I mean, look, I haven't used the platform. I was actually speaking to Chris, from RV Crypto, Blasto Plus, and he started using it, and he loved the experience of it. I have to take it from the network adoption and metrics that I'm looking at. People love it. And so it's starting to really become a competitor even against some of the sexes as well. The problem is, it's not really a problem right now, but what do we know about crypto where, the moats are very, very small. It's hyper competitive. We're going to see a ton of competitors come in the next 6 months looking at what Hyperliquid is minting, which I think is great because, what did Hyperliquid do? They came to market with no VC funding, a massive, fair launch, a public offering of a large part of the issuance, about 30%. And so finally we had a token who actually had product market fit that gave the investors, the public, the right to access it early, right? And didn't sort of, not sell out, but have massive VC insider holdings. And so I think they've set the benchmark, right? If you want to come to market, you've got to sort of adopt a better policy around your token launch.
Also, their burn mechanism, their token economics are good. Very
good. Absolutely. And that's driving price.
That helps. Yeah, that's right. Because it's essentially share buybacks. You're rewarding your token holders for activity on chain.
Yeah. Yeah. It's the perfect tokenomics model, right? Maybe not perfect, but it's been one of the best ones that I've seen so far. But it's all for naught if you don't have product market fit. But they have a great UI and they have a great, the great business, and that put together is you're going to see it, I think, do rather well. There's a massive amount of unlocks that happen around November, so people have to be aware of that. And the asset's getting pretty chunky relative, so that's also a factor. But I still think, based on the growth that we're seeing, that it's got a couple of multiples from here.
So finally, looking across all of the stuff we've talked about, it feels that the market is not really positioned. Liquidity is rising. We're getting to the point where the liquidity multiplier in token prices goes up. We're also getting to the point of alts outperforming Bitcoin, where market breadth is improving. We've got activity across the space growing. We've got the narrative of people trying to build big things or storing wealth in Bitcoin or building big things on other chains. Smells to me like there's a yellow fruit hanging around here somewhere.
It's definitely getting fruity.
It's definitely getting fruity. From my work, as we just think for us it's kind of straight up from here. I don't know where Bitcoin gets to by kind of August, but we got a decent run. I think we'll be surprised to the upside in how fast stuff runs. Then we'll cool off for a bit, but even using Global N2 as a forward indicator, it barely went sideways for a period of time. So that feels like some chop in late summer. And now Global N2 is rising again, and it's got extremely good correlation. Now, it won't be perfect all the way, but it just feels to me that, from here on in, basically, we've got a really good run. And structurally going through your very detailed data-driven approach is telling me the same thing. It's kind of adding to my conviction that, we're about ready.
Yeah. And if then, those things change, leverage spikes or something else happens, hopefully we'll pick it up in those risk scores.
Yeah, and leverage will spike because people love sex and leverage. They're the two things they love the most in the world.
Yeah, that's never going to change.
It's never going to change. Jamie, fantastic. That was really, really helpful. And thank you for everything you do in Real Vision Pro. You're really adding value for people and giving people a framework of understanding this new asset class. So I applaud you for it.
Oh, I thank you, Raoul. Thanks very much for having me.
So look, lots in there from Jamie as ever. You can see the quality of what we do in Real Vision Pro. You get that research, plus you get Julian Battel and myself's research from Global Macro Investors Lens and Andreas, which includes the geopolitics side. It really is that all-star team of mentors that you get to be able to talk to and ask questions. That's the incredible thing about Pro. You're not just reading research. You get to ask me a question, or Julian, or Jamie. Jamie, like me, is fundamentally bullish on where we are going forwards in the crypto cycle. Altseason is pretty much upon us, and the time to lock in is here. So listen, good luck. Remember, don't fuck this up. Don't use leverage. Don't FOMO. Safeguard your assets. Don't fall to any scam. Just be careful out there and just let the wave ride out. You will get corrections on path. Some of them will feel nasty, but over time, the number should go up. Anyway, good luck out there. See you next time.
Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.